Hi, I'm Mijun from Mayab Juicy Ron University. Let's begin today's Mayab Juicy News for October 20th. Welcome to Mijun, where we continue to uphold the fundamentals of investing in United States stocks as always. Mijun family, it's been a while since I last greeted you. Last Thursday and Friday, I took a break from broadcasting to attend my children's sports day events. I hope you've all been doing well during that time. I'd like to share something I felt while participating in the sports day this time. It's been over 2 months since we moved to Malaysia, about 2.5 months now. There was something I noticed as my kids have been attending school here. First of all, although they go to an international school in Malaysia, about 30 to 50% of the students are Malaysian kids. The rest of the kids are actually mostly Asian as well, like Korean, Japanese, or Chinese. But in the past, since my kids attended a school in Cambridge, most of the students were European. About 50% of all the students were British, and out of the remaining 50%, around 40% were from various European countries. Because of that, I could clearly see how my children's competitiveness was changing. First of all, not long ago, there was a math competition. By the way, my second child, my daughter, was really good at math. That was when we were in the United Kingdom. So she was at the top, but after coming here, she took part in a math competition and was only about average. I was really surprised. It really showed me how much of a difference there is in math scores between kids in Europe and those in Asia. My child was almost at the top when we were in the United Kingdom, but after coming here, she was only average. I realized that they do a lot of advanced studying and invest a lot of time in subjects like math in the curriculum. That's what I thought. And last week, there was a sports day, so I went to cheer for the kids. My kids did much better than I expected, so I realized that they really don't get enough exercise. I mean, that's how Asian kids are. Of course, even when my kids were in the United Kingdom, they were pretty good at sports. They were good because they worked hard at swimming from a young age, but European kids usually do 2 or 3 sports every day. So it's not just my kids who are good. There are a lot of other kids who are good at sports too. But after coming here, I realized that my kids' physical abilities are far superior compared to the other kids. So I really realized through this math competition and sports day that kids in Asia study really hard, but their amount of physical activity is way too low. So in the case of our kids, I think we need to increase their study time a bit. I realized that they really haven't studied enough, but at the same time, I also felt proud that they're growing up healthy. Then, after a long time, let's begin today's Mictazin News for October 20th. Last Thursday and Friday, I took a break from broadcasting because of the sports day. In the meantime, Chief Executive Officer Kim In-jung of ChoiceStock posted a very valuable video. As shown here, what is the stock price direction of the top 10 popular stocks from NVIDIA to Tesla? He posted a very interesting video with this topic, and this video, as people say, became a huge hit. The views have now surpassed 45,000. So among all the videos shared by Mr. Kim In-jung so far, this one received the most clicks. But that's not all. There are also over 100 comments, and right now it has an impressive 2,474 likes. The like to dislike ratio is currently 99.2%. That just shows how outstanding this video's quality was. While I was taking a break, Chief Executive Officer Kim In-jung provided such high-quality content, and I want to thank him once again. Since he's such a great lecturer, I expect we'll see more of these hit videos in the future. Now let me summarize what happened in the market while I was away and review the United States stock market over the past week. First, I think it would be good to check the trend by looking at the map. I've set the S&P 500 map to show the past week. So, how did last week look? You can see at a glance that it was a bullish market. There were far more stocks that went up than those that went down, and among the so-called Magnificent Seven with large market caps, there were also many more stocks that rose than those that fell. Everyone rose except Amazon. So tech stocks did well, artificial intelligence beneficiaries did well, and we can see that the overall market sentiment wasn't bad either. So the market breadth increased again and the market improved. Now 43 to 73% of stocks are trading above their 51-day moving average, which means the short-term trend is good. If it gains a bit more strength and goes over 50%, the market could enter a period of stability again. And what about stocks with a good long-term trend? Since it's still over 57%, I personally don't think the market is in a position to collapse. Next is the Market Volatility Index. The VIX is still above 20. Of course, at one point it went over 25, showing some extreme market volatility, but fortunately it has dropped to 20.78 and is stabilizing. Of course, this index needs to fall below the 201-day moving average for us to feel more at ease. You can think of it that way. Next is the Fear and Greed Index. The Fear and Greed Index has dropped to 27. Of course, it had fallen to 23 before, so it's showing a slight improvement now. However, fear is still prevalent in the market. There are still a lot of investors who feel uneasy. It's the same when you look at the timeline. After dropping below 50, it fell sharply and the Fear and Greed Index remains very low. Of course, if this index drops a bit more and falls into extreme fear, from our perspective, I want to stress again that we should think outside the box and view this as a chance to buy stocks. And now there's one very interesting part. The results of the American Association of Individual Investors survey have been updated. Now, if you look at the graph, you'll see that compared to last week, the mood has suddenly gotten much worse. Last week, 45.9% of investors predicted a stock market rise, but now only 33.7% do. For reference, the historical average is 37.5% currently. Fewer investors expect an upward trend than the historical average. Now, if you look at the other side, 46.1% of investors think the stock market will fall in the next 6 months. They are presenting a negative outlook. And the historical average is only 31%. That means we can see that the mood in the stock market has gotten much worse compared to the average atmosphere. And let me say again, the fact that the proportion of investors expressing negative opinions is high is actually a good thing for us. Currently, 46.1% of investors have left stocks and are holding cash. So, if the stock market goes through a correction, this investment capital will flow back into the stock market. In that case, even if the market declines, it's likely to end in a short period of time. Therefore, there's a low chance that a prolonged bear market will occur. Since few people currently hold stocks, only a limited number can sell. Now, when a negative atmosphere dominates the market like this, if stock prices fall, there's a high chance they'll rebound in a short period of time. So, it's right to see it as a buying opportunity at a low price. Once again, I can share a contrarian investment strategy with you all. Next, let's take a look at the performance of Mijun Topic over the past week. Over the past week, most artificial intelligence stocks performed well, so Mijun Topic also did pretty well. At the top, you'll see Celestica jumped 13.4% in a week, making it the top performer. Second, AMD showed an increase of plus 8.46%. For your reference, AMD's 1-month return now exceeds 46%. Third, Broadcom is up by plus 7.6%. The rest showed red. CoreWeave dropped by 1.13% over the week. Talon Energy's Bitcoin exceeds 3, while its return fell by 2%. Strategic is minus 4.90, Bitmain is minus 4.99, Coinbase is minus 5.88, and ProShares Ultra Ether Exchange Traded Fund plunged by 9.15%. Lastly, Bit dropped by 16.89%, which was the worst performance. The last 6 stocks listed are all related to Bitcoin and Ethereum. Artificial intelligence beneficiary stocks have been too high this past week. They performed really well, but the price trends of Bitcoin and Ethereum were not good. That's how we can sum it up. The good news is that the prices of Bitcoin and Ethereum are now forming an upward trend. For example, with Bitcoin, It had dropped to 104,000, but now it's risen to 108,000, showing a recovery trend of about 4%. Next, it's the same with Ethereum. The price of Ethereum also dropped a lot, but after falling to 3,600 like this, the price of Ethereum has recovered to 3,940, showing a recovery trend of about 7%. Before the broadcast, we reviewed the market over the past week, and the market was actually on an upward trend. There were also a lot of stocks that went up over the week. However, many of you may have felt that investing in United States stocks over the past week wasn't that easy. The reason is that the volatility was extreme. Stock prices kept going up and down repeatedly. So what about this kind of volatility? When investing in stocks, this is one of the risks. The risk we usually talk about in stock investment, what we call danger, is actually the volatility of stocks. Now, because of this kind of volatility, if you keep selling stocks when you shouldn't and buying when you shouldn't, you can't get good returns in the end. So today, I'd like to talk about some basic things. I'd like to introduce you to 8 ways for us investors to avoid being swayed by the noise of the market. Now, before I share these 8 methods with you, let's take a look at an article and review the stock market over the past week together. It starts by saying that investors have plenty of reasons to feel uneasy about the current market. First of all, the federal government has been in a shutdown since the beginning of this month, and prediction markets are warning that this could become the longest shutdown in United States history. The Federal Reserve's Beige Book was compiled and released last week, and according to the Beige Book, the economy has slowed down over the past 2 months. This is also a threat factor. And last week, President Trump issued new tariff threats against China. That's not all. Over the past week, investors have been uneasy at signs that banks' credit losses may not just be isolated incidents for individual companies. There was news about small banks taking losses, right? On top of that, when Jamie Dimon, the chief executive officer of JP Morgan, mentioned cockroaches, the mood became very negative. Let's keep reading. Investors seem to be continuously exposed to these risks that move the market. And as a result, what happened to the VIX, also known as the Volatility Index? On Thursday, it closed at its highest since April. And in the end, the United States stock indices fluctuated up and down during several days of unstable trading. This is how we can sum up the past week. Now, however, in the midst of all this, we just celebrated the 3rd anniversary of the current bull market. And it's easy to forget that the S&P 500 index has only fallen about 12% from its all-time high. So what does this mean? Despite the volatility affecting us psychologically, we're actually in a very good place now. Because the bull market that began in October 2022 has now reached its 3rd anniversary. And another thing, the S&P 500 index is currently about 12% below its all-time high. So stock prices are at a very high level. Now, despite that, because market volatility has been extreme, investors' feelings aren't very good. They could be negative. I think that's how we can sum it up. But this isn't the first time something like this has happened. Even just this year, back in April, there were a lot of investors who pulled out of the stock market because of the tariff drama. But as you all know, over the next 6 months, the S&P 500 rose by 35%, and many investors missed out on that upward trend. Now, for those investors, that can be tough to accept. For those who exited the stock market, then it's now a painful regret. That's how you should view it. A market analyst from StoneX, an expert named Pawad Rajakzada, appears, and this expert says the following. An impressive recovery achieved despite all the trade-related headlines and other risks. He stresses the importance of trend following. So, according to him, he's saying that momentum investing is very important. After President Trump's new tariff threats against China, there was a sharp sell-off on Friday, October 10th. But on Monday, there was a notable rebound. They say stocks rebounded quickly after a drop because the market was trending upward. Therefore, long-term investors were able to recover some of their losses, but short sellers had limited time to react to the selling pressure and inevitably suffered significant losses. Throughout the week, investors saw a sharp shift from an uptrend to a downtrend, then back up again. This made it difficult to time the market. It was a week that really showed us just how difficult short-term trading can be. What about Rajak Jada? Trends eventually break, so when investing based on momentum, remember it won't last forever. Eventually, there will come a moment when the trend breaks, but as I keep emphasizing, the trend is your friend. The bull market will continue until the trend breaks, and it's right to assume that. For long-term investors, it might be better to maintain composure amid the market's ups and downs, and for those who decide to leave the market and are looking for a way to re-enter. Staying on the sidelines often means falling behind. So leaving the stock market to try to time it, then coming back in and worrying about when to re-enter, investing like this ends up causing a lot of stress, and there's a higher chance your returns will be lower. That's what they're saying. Darius Dale, Chief Executive Officer of 42 Macro, appears. We coach investors to focus on capturing as much upside as possible during bull markets and minimizing losses during bear markets. And the key is not to overreact to short-term noise. So what this means is that it's right to expect momentum to continue for a while and not to overreact to short-term noise. That's what this is about. If you focus on the ups and downs, like one week it goes up and the next week it goes down, there's a high chance you'll ruin your investment. The important thing is to focus on the long-term and mid-term trends. Once momentum starts to rise, it's right to assume that this upward trend will continue until a major catalyst appears. It's the same when the market is falling. Instead of thinking that the downtrend will end just because it's been dropping for a week or two, it's actually more reasonable to assume that the downward momentum will continue until a significant positive event occurs and the trend turns upward again. You can understand this as an investment lesson. So what is the market telling us right now? Last week, as the fourth quarter earnings season kicked off in earnest, many major financial institutions reported their quarterly results. Investors often pay close attention to earnings calls, but now this has become even more important. Because official data sources have been suspended due to the government shutdown. So, in order for investors to get clues about the economy, this time they paid much more attention to corporate earnings calls than usual. That's how you can see it. This is what explains the strong market reaction to the cockroach comment in the private credit sector, which was mentioned by John Pierpont, Morgan Chase, Chief Executive Officer Jamie Dimon. That's what they're saying now. Now, there aren't that many economic indicators we can refer to. That's why experts say that a single comment from a professional or a company's chief executive officer can trigger a huge reaction. At that time, John Pierpont Morgan's chief executive officer, Jamie Dimon, revealed that Giant Bancorp had disclosed a $50 million loan loss. He also said if there's one cockroach, there could be many more cockroaches. This triggered a financial sector sell-off on Thursday. Now, here's the view of Matthew Malley, chief market strategist at Miller Tabak. Now, if these concerns about the credit market continue to spread more widely, it will definitely create headwinds for the market. Malley also noted that besides the financial sector, major big tech companies are in the market. Now, Malley also argues that concerns about major companies are widespread, and therefore expectations for their earnings are much higher. Now, if the results don't meet those high expectations, he argues that we could see similar sell-offs in individual stocks or sectors. Now, the expert Mallory is also pointing to the VIX as an indicator of what investors are doing. Even though there hasn't been much selling outside of bank stocks, the VIX has gone up a lot. The Fear and Greed Index has also dropped a lot. What that means is, as fear in the market has grown strong enough, investors have bought a significant amount of protection. That's what he claims. Now, what this means is that it's a hedge against a market downturn. It means buying put option contracts on the S&P 500. Now, the market is too strong right now to say that the upward momentum has ended. There are still many experts who are not leaving the bull market. On the other hand, since various risks are emerging, people are now buying put options on the S&P 500. A put option is a bet on a decline in stock prices. So, while they are still betting on a bull market because they feel uneasy, they are buying a lot of put options to offset some of the losses if the market falls. This is how the current market situation can be summarized. Because investors haven't seen a significant decline for a while, they might be hedging against a potential market downturn. Despite the selling pressure on October 10th, the S&P 500 hasn't experienced even a 3% drop since April. There hasn't been a single 3% drop since April. It's been an incredible bull market. Steve Sosnick, Chief Strategist at Interactive Brokers, is here with us. The drop on October 10 reminded people that there are risks involved in investing in stocks. A lot of people thought that the stock market would just keep going up. Sosnick says this round of selling is a way for the overheated system to let off steam. Therefore, something essential for a healthy market has occurred. Sometimes it's actually more positive for stock prices to fall and then rise again. That's what they're saying. Sosnick should take Friday, October 10th, as an opportunity for an instinctive check. If you were shaken by this level of decline, it means you're taking on too much risk. That's what they're arguing. However, other investors didn't let the headlines change their investment logic. That means even though the market is being shaken a lot by the current headline news, they are still holding on to their expectations for a rise. Dennis Skelly, Head of Market Research and Strategy at Morgan Stanley. Although the recent United States-China trade conflict is making headlines in the market, the story remains the same for stock investors. It's important to focus on large-cap blue-chip stocks. They say buying good company shares and waiting will make the stock price rise. Now, Darius Dale from 42 Macro has something very important to say. He argues that one of the best things an investor can do for themselves is to establish investment principles that they can follow in any market situation. What's the top thing you should do as an investor? He argues that it's about adding guardrails to your investment decision-making process and evaluating every decision in advance with the outcome in mind. Like saying, if X happens, I'll do Y. According to Deal, it's not just about enduring periods of loss. The world's top investors all operate with very clear and black and white rules when it comes to risk management. They don't hesitate to give this advice. So in Mijun's words, I'm going to share with you 8 ways to avoid being swayed by the noise of the market. So I also believe that for investors to withstand the volatility of the stock market, the most effective measure is to have investment principles that you can follow in any market situation. Now, I'll organize and share with you the investment principles I've personally established to avoid being swayed by the noise of the market. The first one is this. Build your portfolio with stocks that have low market penetration but high market share and growth rate. Therefore, it's important to construct your stock portfolio while looking at the fundamentals. You can interpret it in this way. As you all know, I am artificial intelligence, blockchain, autonomous driving, humanoid robots, and smart glasses still have very low market penetration. That means there aren't many users yet. Instead, the companies I'm investing in all have very high market share and excellent growth rates. You can think of them as such. Those are the kinds of stocks I'm talking about. Even when stock prices drop, they usually rebound. Now, secondly, only invest in companies with positive net income or at least positive operating cash flow. This is my second investment rule, and it's a rule I created after experiencing the bear market in 2022. Before that, I used to invest a lot in loss-making companies, not just profitable ones. But I believe that if you only invest in companies whose financial statements are likely to improve continuously in the future, you can minimize the chances of investment failure. So as much as possible, I try to avoid loss-making companies. Third, when the entire market is falling together, it's important to buy stocks. When stock prices drop unfairly due to external factors, regardless of the company's fundamentals, buying these stocks at a low price is the wisest decision. Fourth, when the overall market is rising but a particular stock is falling on its own, this is not a buying opportunity, but a selling opportunity. Stocks whose prices are falling regardless of the market atmosphere, especially growth stocks. Usually this occurs due to issues with the fundamentals. When fundamentals are weak and the stock price falls, a 20% drop could just be the start. It may continue to decline by 30%, 50%, or even 70%. Therefore, to prepare for these situations, I think it's best to either cut your losses or take your profits on that stock. Now, when you sell a stock that has dropped like this, it can feel like a real waste. You might think, what if this stock goes back up? But at that moment, there's one thing you need to remember. Remember, the world is big and there are many stocks to invest in. I sometimes say this jokingly. Always judge your spouse absolutely, but assess stocks relatively. Is this stock really the best choice? When the stock price drops, you shouldn't focus on whether this stock will go back up. I want to emphasize that you need to look at whether there are other stocks with a higher chance of rising than this one at the current moment, and that you should consider other stocks. Now, the fifth rule is this. When the stock market rises and the cash ratio in your portfolio drops sharply compared to your target, you need to sell some stocks to increase your cash ratio again. Now, on the other hand, if the stock market falls and the cash ratio in your portfolio suddenly rises above your target, you need to buy more stocks to lower your cash ratio. Now, seventh, when adjusting the seventh ratio, it is safest to select stocks for trading based on momentum. In other words, increase the proportion of stocks with strong momentum and decrease the proportion of stocks with weakening momentum. I believe this is the way to maximize our returns. Now, the eighth rule, you should always maintain your cash ratio at a level where it's okay whether things go well or not. What that means is, even if stock prices go up right now, it's not a bad thing. And if stock prices fall, you still have cash, so you won't take much of an emotional hit. Stock investing is a marathon. Ultimately, the investor who lasts the longest wins. So rather than maximizing short-term profits, I believe the key to success is who can enjoy the magic of compound interest for a longer period of time. So, can I really invest with a happy heart for the next 10, 20, or 30 years? Hey, I believe that building an investment strategy with this kind of mindset and attitude increases your chances of success. It's been a while since my last broadcast, so I'll read another article today. Now, this time let me introduce one of the top picks strongly recommended by John Pierpont Morgan, a leading investment institution in the United States. It starts by saying that a major bank on Wall Street now believes Credo technology is an excellent stock to ride the wave of artificial intelligence. On Friday, John Pierpont Morgan analyst Joseph Cardoso began coverage of Credo Technology National Group Holdings. Until then, they hadn't covered this stock, but now they've started to cover it and have begun their evaluation. The first rating they gave was overweight, which basically means they're recommending to buy. The target is $165. As you know, Credo is a leading company in the high-speed data connectivity sector used in artificial intelligence data centers. This company offers a variety of products, including optical devices and data networking chips. But the most important product is the active electrical cable, which stands for active electrical cable. Now you can think of this as the biggest part of Credo's business. What about Joseph Cardoso? This company claims that Credo Technologies has strong and scalable relationships with the largest cloud service providers. Well, the largest cloud service providers listed here include Microsoft, Amazon, and Meta, for example. Also, what does it mean to have scalable relationships? These companies already generate significant revenue, and with accelerating infrastructure investments, their contributions could grow even more. So, this explains that Credo is well positioned to benefit from the increasing demand for active electrical cable. So, over the next few years, we can expect strong revenue growth and margin expansion to be achieved like this. For your reference, Credo's stock price rose an additional 5.19% on Friday and has already surged 107% so far this year. Credo directly invented the active electrical cable, a copper-based cable used to connect artificial intelligence servers to networking switches. Active electrical cable is selling well because it offers higher reliability and lower power consumption than optical cables. It supports longer distances than traditional passive copper cables like optical cables. Therefore, you can see that active electrical cable has become one of the biggest beneficiaries of the current artificial intelligence revolution. What about John Pierpont Morgan? Credo is expected to continuously achieve annual sales growth of over 50% until 2028, and net profit growth is also expected to consistently exceed 7%. He also mentioned Microsoft, Amazon, Elon Musk's xAI, and Meta platforms as clients, and he won't stop there. Because although they are not clients yet, He claims that Oracle and Alphabet's Google are also potential future clients for Credo. Something important is mentioned at the end. Free cash flow is mentioned, our expectations for solid improvement in free cash flow generation, and considering the already strong balance sheet. They argue that we can't rule out a greater desire for capital allocation. So, they claim that our bullish outlook, is based on this. Let me explain this in one sentence from Mizone. Now, at the end of the article, John Pierpont Morgan's analyst said this: a solid improvement in free cash flow generation is what we are expecting. In addition, the balance sheet is already very healthy. These two factors are the reasons for the positive outlook, according to them. So what that means is that people usually invest in cred technology because of its high growth potential. But not only that, it's also very financially sound, so it has enough capacity to return profits to shareholders. That's what they're emphasizing. The surplus cash flow here is called free cash flow in English. You know the money a company earns from its business. After deducting taxes, operating expenses, and even capital expenditures, the real cash that's left over is what we call surplus cash flow. The company can use this money to pay off debts if needed. It can also be used to pay dividends to shareholders or to buy back its own shares. It's basically discretionary cash that can be used freely. That's why it's called free cash flow. Cardos, the analyst, is saying this. He is presenting the outlook that Credo's free cash flow will continue to increase even more in the future. That's not all. There's one more thing about Credo. They are praising that the balance sheet is very sound. In other words, because the company has low debt and high assets, it is financially stable and has excellent crisis management capabilities. That's what they're saying now. Now, if you actually look at Credo's balance sheet, you'll see some impressive numbers. Now, I'm currently on Credo's page on Seeking Alpha. If you scroll down, we can check the balance sheet ourselves. All right, let's scroll down and take a look. Here it is. At the top of the balance sheet, you'll see cash holdings totaling 479 trillion won. Now, if you look right below that, you'll see a dash. That's the liabilities. The liabilities are 1,561. They only need to repay about 15.6 million. But the amount of cash they currently have is a whopping $479 million. So compared to their liabilities, they have an abundance of cash. If you look below that, you'll see total debt to equity. Equity refers to the capital you own. It's your own money. The ratio of debt to your own money is 2%. What this means is, if Cred has 1 million won in equity, the amount they've borrowed is only 20,000 won. It's extremely rare to find a growth stock with such an incredibly sound financial statement. Therefore, they're claiming that this is a major strength. The surplus cash generated by the company keeps increasing, and on the other hand, there's no debt that needs to be repaid in the first place. In the end, the only option for the surplus money is to return it to shareholders. That's the logic here. Because, as I mentioned earlier, surplus cash flow is like this. It already accounts for all the money spent on R&D development, and even all the capital investments have been made. Even after expanding factories and all that, the cash that remains is what we call surplus cash flow. Plus, with no debt, there's nothing to repay, so what can you do with the extra money? In the end, it's highly likely that they'll either buy back their own shares or increase dividend payments. John Pierpont Morgan is emphasizing Credo now because it's not just a high-growth stock, but also attractive for its ability to return value to shareholders. Over the past year, Credo's stock price has jumped over 280%. Therefore, its valuation is high, with a forward PAR reaching 96.81, making it very expensive. So if it fails to maintain a growth rate that exceeds market expectations in the future, its peg will eventually rise. Currently, the peg is low. Look here, the peg is 0.53. This means dividing the PAR by the current growth rate gives less than 1, highlighting how strong the growth rate has been. Since it's a cheap stock compared to its growth rate, the stock price can go up. But if this growth rate declines, it will eventually become an expensive stock, which could give a reason for the stock price to fall. That's how you should see it. Therefore, I want to conclude by saying that you should always check the growth trends of sales and earnings every quarter when investing. This is a stock you need to keep an eye on. What's the last content we've prepared for today? This is today's United States stock video. Today, we'll also look at the opinions of major United States experts through a dubbed video. Among those of you joining us for this broadcast, there may be some of you who have been having a hard time lately because of the prices of Bitcoin and Ethereum. Artificial intelligence stocks are doing really well, but only Bitcoin and Ethereum are dropping. Especially recently, since Ethereum was included in the United States top picks, those of you who bought it not long ago might be feeling a bit down because your returns are negative. So for people like this, Tomney has recently been showing that he's going all in on Ethereum. Let's listen closely to what he has to say and find out exactly what investment logic he has. That's it for today's Big Stock News on October 20th. It's been a while since our last broadcast. I hope it helped your investments. I hope you continue to have a healthy and happy experience investing in United States stocks with me on this week as well. Let's all keep fighting together until the day we can retire through United States stock investing. Have a happy day. Thank you.
One of the things I've consistently argued is that the Ethereum network, in other words, its market capitalization, will surpass Bitcoin. Right now, Bitcoin's market capitalization is about $2.4 trillion, and Ethereum's is around $540 billion. I'm saying that this so-called flippening will happen. I'd like to hear your thoughts on this topic. To give a bit of context, as our podcast listeners may know, we have a long-term forecast for the size of the entire crypto asset ecosystem in 2030. Of course, this will be updated over time, but according to our recent estimates, the size of the crypto asset ecosystem in 2030 is expected to reach about $25 trillion. We expect that most of this will be Bitcoin. The reason is that we have been tracking Bitcoin since 1971 because we view it as a rules-based global monetary system that ended when the United States left the gold standard. This is an incredibly big idea, and at the same time, it's a technology and the first example of an unprecedented new asset class. We published a paper about this in 2016. All three of these are very big ideas. That's why I'd like to hear Tom Lee's thoughts on whether Ethereum or its ecosystem could surpass Bitcoin or go beyond Bitcoin.
All right. If we go back in time a bit to 1971 in our chairman's message last month, we talked about how gold and Wall Street have grown since 1971. 1971 was the year Nixon officially took the United States off the gold standard. The immediate beneficiary of this move was gold. Demand and a market for gold emerged, and many people. This is the first ripple effect. But the key point we emphasized in our message is that in 1971, the dollar became a fully synthetic currency backed by nothing. As a result, there was a risk that the world could move away from the dollar standard. That's when Wall Street stepped in and created financial products that would expand the future of the dollar. Around 14 financial products such as money markets, funds, credit, mortgage-backed securities, and futures appeared that decade. As a result, the dominance of the dollar expanded from about 27% of global gross domestic product to 57% of central bank foreign reserves and 80% of global financial transactions. Wall Street established dollar hegemony through these financial products, and today the stock market's capitalization is $40 trillion compared to gold's $2 trillion. In other words, gold accounts for only 5% of total assets. Now, looking ahead to 2025, we see that everything is moving toward tokenization rather than being synthetic. Beyond moving the dollar onto the blockchain in the form of stablecoins, even stocks and real estate will be transferred on-chain. And this is exactly why I believe this will be an opportunity for Ethereum to gain dollar hegemony. Bitcoin is digital gold, and in this world we see that Ethereum could surpass Bitcoin just like after 1971 the dollar and the stock market overtook gold starting on a Monday. Of course, this is just our working hypothesis. I am still a Bitcoin bull myself. I am very optimistic about Bitcoin, and I believe that Bitcoin's target price is definitely achievable. We estimate Bitcoin's fair value to be at least $1.5 million or $200,000, and we think even higher levels are possible. I believe that this rise in Bitcoin will ultimately provide strong upward momentum for Ethereum, which is a neutral smart contract platform where Wall Street's innovation of tokenizing real-world assets will unfold.
There is Bitcoin